Today, I'm diving into the saga of Cleveland-Cliffs, a Midwest steel titan that's been dreaming of a red, white, and blue industrial renaissance, but instead got a front row seat to a protectionist plot twist. This is a story of tariffs, unintended consequences, and a company learning the hard way that economic policies aren't fairy tales with guaranteed happy endings. Okay, so Cleveland-Cliffs is a vertically integrated steel empire. They mine iron ore from the rugged landscapes of Michigan and Minnesota, smelt it into steel, and then shape it into car parts, sometimes at their own stamping facilities, and sometimes for customers who supply automakers. They're a one-stop shop for steel, with 66% of their business tied to cold-rolled, hot-rolled, and coated steel for the auto industry. They also dabble in electrical steel for motors, power line infrastructure, and solar installations, but cars are their bread and butter. In 2023, they posted $22 billion in top-line sales, making them a heavyweight, though not quite as big as their rival Nucor, which raked in $35 billion. Oh, and in 2024, they scooped up Stelco, a Canadian steelmaker, adding a transporter twist to their portfolio, which, spoiler alert, maybe isn't such a great transaction with the recent news. Now, Cleveland-Cliffs has been waving the protectionist flag for years, lobbying hard for tariffs to shield American steel from unfair foreign competition. Their annual report paints a dramatic picture: foreign steel dumpers flooding the market, undercutting honest American producers. They point out that the U.S. is unique among steel-producing nations, consuming less steel than they produce. In their view, the 34 million tons of steel imported in 2024 were 34 million tons of lost sales. Tariffs, they argue, would level the playing field and nudge auto companies to buy American and spark a manufacturing revival.
Tariffs are a matter of national security. There's no country without manufacturing and no country without steel making.
You don't want Chinese steel making our tanks and houses?
Sounds like a patriotic slam dunk, right? Well, hold that thought. Enter March 12, 2025. President Trump, never one to shy away from bold moves, slaps a 25% tariff on all steel and aluminum imports. No exemptions, not even for Canada, where Cleveland-Cliffs, a shiny new Stelco subsidiary, operates. This was the moment Cleveland-Cliffs had been waiting for, the trade barrier they'd championed. They expected to ride a wave of reshored auto production, with American car makers ditching foreign steel for their homegrown product. But here's where the plot thickens, and not in a good way. Instead of a steel renaissance, Cleveland-Cliffs found themselves in an economic horror show. The tariffs, meant to protect domestic producers, sent shockwaves through the auto industry. Car companies, spooked by rising costs and economic uncertainty, started slashing orders for steel. Why? Well, tariffs don't just make foreign steel pricier, they ripple through supply chains, inflating costs for everyone. Auto analysts, like those at Cox Automotive, forecast a grim 2025, predicting U.S. auto sales could drop by 1.8 million vehicles due to higher prices and disrupted supply chains. With car makers tightening their belts, demand for Cleveland-Cliffs cold-rolled steel, the backbone of their business, tanked. The fallout was brutal. And on March 28, 2025, Cleveland-Cliffs announced they were idling their Dearborn, Michigan plant, laying off 600 workers. And they also shut down 2 iron ore mines in Minnesota and Virginia, axing another 630 jobs. That's over 1,200 livelihoods hit, all because the auto industry, their biggest customer, was reeling from tariff-induced chaos. Interestingly, their Stelco facility in Hamilton, Ontario, dodged layoffs, possibly because the 2024 acquisition deal bars workforce cuts. Meanwhile, Stelco's Canadian competitors weren't so lucky, with 200 workers laid off as Canada grappled with U.S. tariffs in their own way. Cleveland-Cliffs insists these cuts are temporary, a strategic move to rebalance working capital and clear excess iron ore pellet inventory from 2024. They're banking on a future where Trump's tariffs magically reshore auto production and Dearborn roars back to life. But that's a big if. Let's talk numbers, because the market isn't buying Cleveland-Cliffs' optimism. Their stock has been in a free fall, dropping 65% over the past year to a 52-week low in the $7 range. Compare that to Nucor or other U.S. steelmakers who have had a rough year but aren't scraping the bottom quite like Cleveland-Cliffs. According to their Stelco merger deck, Cleveland-Cliffs ships the second highest tonnage of steel in North America, yet their market cap is the lowest among major players. By most valuation metrics, like price to earnings and price to sales, they look like a bargain. But there's a catch: cash flow. Investors see a company bleeding jobs and betting on a shaky auto industry rebound, and they're not biting. So what's going on here? Let's reason through it. Tariffs sound simple. Tax foreign goods, boost local ones, but they're a blunt tool. The 25% steel tariff combined with a 10% blanket tariff on all imports and a whopping 145% tariff on Chinese goods created a perfect storm. Electronics, critical for modern cars, are China's biggest export to the US, worth $125 billion in 2023. Steel imports, by contrast, were just $13 billion. When Trump tweaked the electronics tariff to 20%, it added more uncertainty. Higher costs for car components mean pricier vehicles, lower sales, and less steel demand. Cleveland-Cliffs, despite supporting tariffs, didn't anticipate how deeply they'd disrupt their auto customers. There's a touch of irony here. Cleveland-Cliffs, a tariff cheerleader, got burned by the very policy they pushed for. Their CEO, Lourenco Gonçalves, has been vocal about tariffs penalizing foreign competitors and strengthening American manufacturing. Yet, as Bloomberg noted, the sweeping 2025 tariffs hurt Cleveland-Cliffs more than the targeted 2018 tariffs, which had exemptions. It's like ordering a spicy dish and then complaining it's too hot. Except the dish cost 1,200 jobs and billions in market value. So what's next? Cleveland-Cliffs is playing the long game, hoping tariffs eventually force auto production back to the US, boosting steel demand. But analysts aren't optimistic. The auto industry's supply chain is global and complex. Reshoring takes years, not months. Meanwhile, higher car prices could suppress demand, and global trade wars might worsen the slump. For investors, Cleveland-Cliffs might look like a value play, but it's a risky one, hinging on a manufacturing revival that's yet to materialize. In the end, Cleveland-Cliffs' tale is a cautionary one. Tariffs sold as a shield for American jobs can backfire, hammering the very companies they're meant to protect. Cleveland-Cliffs bet big on protectionism and got a reality check. In economics, there's no such thing as a free lunch or a free tariff. As they navigate layoffs, a battered stock, and an uncertain future, one thing's clear. The steel giant's American dream is on hold, and it's going to take more than tariffs to bring it back. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, and ring that notification bell. Guys, also let me know what you think in the comments section. Thanks for watching, everyone.